Farm and auto both continue on a very strong operating track. You see the market share gains. SUVs up 130 basis points. LCV up 160 basis points. And tractors up 180 basis points. All of this wasn't planned at the start of the quarter. It just happens to be in similar ranges. Beyond market share, continued margin expansion. And that results in auto with a 35% increase in profit after tax and farm with a 4% increase in a tough market. Mahindra Finance is unlocking its potential. We are starting to see results. We've been talking about a turnaround that started a year and a half ago. We are still halfway through the turnaround, or a little more than a year and a half ago. And we're starting to see some very strong results. GS3 continues to be low, below 4%. We were at 3.4 at the start of the year. First quarter is always a slight uptick at 3.6%. Beyond that, assets under management grew 23%. And we can see the impact of low credit losses on the overall financial numbers. So profit after tax is up 37% for Mahindra Finance, off a pretty strong base last year. Tech Mahindra, the turnaround has commenced. Q1 is on the right track. And we will go through a 2 to 3 year turnaround plan there. And you will see continued results on that as we go quarter by quarter. Overall, consolidated profits are up 20%. This does exclude the impact of one-timers that we had last year in the profits, which was a gain on KG Mobility and a gain on the sale of Mahindra CIE shares. So excluding that, PAT from a consolidated standpoint is up 20%. ROE is at 19.4%. And as we look at the overall consolidated picture, revenue up 10%, profits are at 3,283 crores, as I said earlier, up 20%, excluding the one-time gain last year. The key drivers of our profits, auto and farm combined up 18% for the quarter. Beyond the market share gains, SUV capacity continues to increase. We have tripled capacity in the last 4 years. And that tripling of capacity now helps us in terms of being able to meet the backlog of demand and be more aggressive in the market as well. And despite being more aggressive in the market, we've been able to deliver a very strong margin performance. Tech Mahindra is up 23%, off a lower base, and therefore we continue to maintain a high bar for the business to get back fully from a turnaround standpoint. Mahindra Finance is up 37%, off a pretty strong base. And on the growth gems, where we've got a 5x challenge, they're again on a strong path, up 34% year over year. But more than profits in growth gems, what we look at is the underlying businesses and are they being set up for that 5x growth, because we're looking for long-term growth of that business, not short-term profit. So while it's up 34%, this is not a number that I look at very closely to say it should be up in high numbers. More important is the underlying businesses, and they're at this point doing very well. So let's focus a little deeper into each of these. Auto continues to be the number one SUV player. Volume is up 24%. We had talked about mid to high teen volume growth when we talked about F25 a few months ago. And in the first quarter, at least, we have exceeded that by growing 24%. Capacity I spoke about, and the margin expansion is 180 basis points. Again, a very healthy margin expansion on the auto front. Market share we spoke about, resulting profit is 1,330 crores from an auto standpoint, which is now inched ahead of the farm profit, which is 1,238 crores. And Farm has seen some improvement in domestic outlook, but industry has been relatively flat. Hemant will share the details for the first quarter. And despite that, due to the market share gain, we've seen good progress in this business. International markets have moderated, but due to strong execution, margins gone up 100 basis points here, which again, in an industry like farm, is a pretty tough act, and a lot of kudos to the team to drive that margin expansion. Mahindra Finance, in addition to the asset quality and growth, technology is a key part of our turnaround, and we have 100% of branches now under a central processing system with a much better tech system. A lot of work has been done on technology. We aim to be the best in class in the industry, and we are well on our way. That's the remaining year and a half or so of turnaround that Mahindra Finance will undergo, is largely from a tech standpoint. And here you see almost 500 crores of profit for the quarter for Mahindra Finance. This is a pretty remarkable number. We're at 497 right now, just shy of that 500 crore number. Tech Mahindra, the new organization is focused on service delivery. The demand signals are still mixed. You see good numbers from a previous year comparison standpoint, but again, to be very transparent, previous year was a low point, and therefore we look more at, are we on track with the turnaround plan as compared to the numbers of the previous year. Logistics is on a better track now, though not completely out of the woods as yet. It's executing far better, and the express business now, despite showing losses this quarter, is on a very good track. And as committed by the management team there, we expect that business to turn around by the end of the current quarter that we are in. Revenue is up 10%, but EBITDA has been hit by the express business and therefore is down as compared to the previous year. On holidays, you see very good progress. Again, occupancy is robust at 90% plus. Memberships continues. We're now at 300,000 plus total members. And average unit realization is up 31%. Real estate, again, very healthy addition in GDV, strong pre-sales momentum, and that's up 3x compared to last year, and a strong start to the year for our industrial cities as well. So we've got our listed growth gems on a very sound footing, and our unlisted growth gems are also on track in terms of where we want them to be. So on balance, very strong operating performance, leading to a consistent delivery on our commitments. ROE greater than 18%. We are at 19.4 for this quarter in particular, and EPS at 29 for this quarter, but on track for long-term 15 to 20% EPS growth as we've committed. With that, I'd like to invite Rajesh to talk about the auto and farm businesses in more detail.
Thank you, Anish, and good afternoon, everyone. I'll start with farm equipment, and Anish spoke a little about this. We grew our volumes 5% in a quarter where the industry was flat to slightly negative. Exports growth was very strong at 45%, and this was our highest ever quarter volume. And we reached a market share of 44.7, which was a 1.8 share point gain, which is what enabled us to get the 5% volume growth. You can see a consistent improvement in our market share with time, and quarter one was one of our very healthy market shares. We're seeing some green shoots in the tractor industry. We're not changing our annual forecast as yet, but the green shoots are as follows. The terms of trade and price realization both are becoming more favorable for farmers, so that's a positive enabler. Positive monsoon outlook. July has been pretty good in most parts of the country, so most critical markets have been impacted positively, especially the west and south. Improved government spending, both state and central level, in agriculture and rural both. And of course, the second half this year is going to have a start of Navratra towards the end of March, which wasn't there last year. Farm machinery continues to grow, and quarter one was a revenue of 265 crores, which is a growth of 34%. Anish covered this, so I'm doing this quickly. 5% was the growth in PBIT. The farm margins, and I'm focusing right now on the core tractor margins, just for clarity, core tractor margins are the margins we make out of our domestic tractor business plus exports from India. Doesn't include farm machines, doesn't include farm machinery, Powerall, and global subs. So that's gone up to a very healthy level of 19.7%, which is a 1% improvement in margin. You see the same on the farm standalone side. We continue to have a very strong margin growth, and you can see 19.7 is very strong and improved margin after many quarters. The last time we ended the year, F20 was around, that was full year average at 19.7. So very, very good improvement in margin in quarter one. On the auto side, the SUVs grew 24%. Revenue market share went up. We're again number one by way of revenue market share. And again, the LCV market share, the less than 3.5 tons, improved by 160 basis points to cross 50%. This is the trend that you see on the SUV volumes and the revenue market share, which was at 21.6% in the quarter. This slide is just a recap. It's to say that we have improved our capacity. We are in line with the capacity increases that we had planned, and we are on track to complete this capacity expansion plan that we had shared earlier. This is the status of bookings on 1st of July. So this is not today's bookings. This is on 1st of July. Since this month has not ended, we are going to the start of the month, and you see the new bookings as well. I just wanted to state here that, one of the reasons we've increased capacity is to make sure we bring down customer waiting time. We're already beginning to see that. And this chart was created in an era when customer waiting time was very high. That era, we think, is behind us as we've increased capacities. This is the last time you will see this chart for some time. XUV 700, I just want to take a couple of minutes. Many people had thoughts and questions. So what happened? And why did we do an anniversary offer right time at this time? We had increased prices on the top two variants between 3.8 lakhs to 4 lakhs. So this was the extent of increase. Commodity prices had gone up a lot in the period since we launched 700. There was escalation and a shortage in chips availability, which had led to increased material cost, and 700 had a lot of chips. We've increased the capacity over since launch. So we started at 3,500. We hit 6,000 capacity. Now we're at 10,000. So there is a need and a desire to start leveraging our capacities. Overall, our costs have come down for two reasons. One is, we've of course done value engineering. Post-launch of a new product, we spend effort in removing extra costs which may not be adding value to customer. And as I mentioned earlier, we normalized the premiums that were there on chips at one point of time has all gone away. There's no chip shortage now. We don't have to pay any extra market price for that. So that's brought material cost down. We expect this anniversary offer to have minimal impact on financials because we expect higher volumes. We expect the costs have already come down, and we will get operating leverage out of the higher volumes. Our bookings in the month of July have gone up over 40% on 700 compared to the previous month. So we're already seeing very good momentum come out of the actions that we've taken. On the LCV side, the industry continues to be flattish. We've gained market share, so our volumes have grown a little. But hopefully, as we get into the second half, we will start seeing the segment industry grow compared to what we've seen in the last 18 months. Last mile mobility, we continue to be number one. The very interesting thing here now is that in this segment, EV penetration is at 20%. So it's the most penetrated segment with electric vehicles. As we had mentioned earlier, We expect that as new players come in, the penetration will improve, the category will grow faster, and that is exactly what we see happening here. So the auto consolidated revenue grew 16% and PBIT grew by 45% to absolute number of 1,787 crores. The auto margin, I think, is really the highlight on the auto business for us. We have been talking about margin improvements and giving some kind of a guidance on the direction. We're very happy that we've got to 9.5% margin. Some of you had in mind, the 3XO launch that was happening in Q1, and what would that do to our margins? And some of you who were at the launch did ask us, how are you ever going to be able to finance these kind of prices that we launched at? Well, 9.5% answers that question. With that, I'll hand over to Amar. Thank you.
Thank you, Rajesh. So I'm going to try and wrap it all up, what you heard today. As Anish mentioned, we had 10% growth year over year. But within this, there's been some very strong performance from auto and farm. And we've also continued to see strength in Mahindra Finance, because as the assets have grown, their revenues have grown as well. So overall, the auto business saw a 16% year-over-year growth on a consolidated basis. Farm was flat, but domestic was up significantly, even though the market was flattish, whereas international was a bit down. And that's something that we are watching as we go through the year, how the international markets behave. And the US in particular has been a very challenging market, as you would have heard Rajesh talk about. So overall, when we look at the revenue growth, very strong. I want to spend a little bit of time on the right, because I think there's one item in particular that I want to spend some time clarifying. You see the 763 crores that Anish called out as well. Often this gets misunderstood. What is it exactly? There are two types of incomes that we get from our investments. There's income that we get when we have an associate or a joint venture, which is just regular pickup of their dividends, etc., and that's recorded as revenue and recorded in the margins. Then there is investments where we don't have any control, which go as other income, and that's KG Mobility, for example, where it was a pure, we have a holding in the company, and as the share price goes up or down, you get a mark to market on it. So last year, when the stock got listed, we booked a 405 crore gain. That, of course, doesn't repeat this year, and in fact was a net loss because of some issues that that business has, which is all in the press, so I'm not going to go through the details. So on a year-over-year basis, we are actually seeing a net negative impact of KG Mobility, but that's not a reflection of operating results, which is why we call it out separately. Similarly, there was an investment in an associate that we exited, which was MCIE, and we took a gain at that time, and that's the remaining 358 crores, which doesn't repeat this year. So as you look at the future, and this is something that we want you to take into account, that other income bucket is going to keep seeing some fluctuation because of mark-to-market of our investments. Our true operating performance keeps coming through our PBIT line, our PAT line, and excluding this other income fluctuations, you should be able to see very strong operating results, which is why you see this 20% figure here. Okay, so I just wanted to call that out specifically. This is one chart that is starting to see the strategy come into play. And Anish talked about it, but I wanted to round it out with numbers. If you look at the numbers that we got from auto, again, very strong auto and farm, very strong impact on year-over-year performance. But what is really interesting and something that we are watching closely is the services contribution to the PAT growth. You can see it's 148 crores this quarter, year-over-year impact, which is coming from Mahindra Finance and TechM. And as you have been hearing Anish talk about unlocking full potential, this is where we expect more and more to come as these two businesses fix their performance. Mahindra Finance well underway. TechM, as Anish mentioned, is something that we have started the journey on. Standalone, I won't spend too much time because Rajesh has gone through a lot of the details. Again, highlighting that on a standalone basis, those two one-off impacts are being called out. X that, we have a 23% growth in profit on an 11% growth in revenue. The 11% growth is primarily lower because of farm being on the lower side and auto being very strong growth. But considering what the situation was just in the fourth quarter, farm has had a remarkable first quarter in that context, and we are watching the outlook on the monsoon closely to see how it pans out for the rest of the year. Okay, so with that I'll wrap up and we'll open it up for Q&A.
So we begin our Q&A. May I request those present here to please introduce yourself. It will help us with our transcripts later. And yeah, followed by your questions. Can we start? Yes, please.
Hi, gentlemen. A very good afternoon and congratulations yet again. A great set of numbers. Just a couple of questions. Firstly, on to the discounts that were given or the price cuts for XUV700. Indeed, a great news for the customers. But going ahead, will the company be open to take more price cuts for any of the other cars? Just wanted to take on that. And this 9.5% auto EBIT margins, with the kind of definitely there will be a volume push, but apart from that, are they near to the peak or the company is hopeful of building on to more margins? Is the first question. And also, with respect to the EV sales, since we are seeing a lot much of news flow with regards to EVs and hybrids now, government is taking steps. So what's M&M takes on EV? Because for FY25, you do have big plans. So how are you seeing the industry growth? Thank you.
Okay, so Shrishti, I'll just give a quick headline on the XUV700 price question, and then Rajesh will take the details. We've always tried to be fair with our customers. So when commodity prices were higher, when there were a higher price and capacity constraints, we had taken up prices at that point in time to reflect the margins. As commodity prices came down, as the chip supply became more open, as the prices for chips came down as well, we started to see better margins, and that's the benefit we're passing on to customers. Also, with capacity going up to 10,000, we can be a lot more aggressive in the market as well. So it's a combination of all of those things. Rajesh?
Yeah, Shruti. So just to build on what Anish just said, and we've always consistently said this, that our role as leaders is to ensure the right balance between creating value to customer, getting volume growth, and managing the margins. And it's really a triangulation of these three things that we trade off at any point of time in our decision-making process. If we were to dial back to the February similar conference that we had at that point said that we do want to create greater accessibility for 700. We've taken some actions around that. So we did create a special AX5 variant a month and a half, two back, and we felt we did need to do something more on AX7 and AX7L. Like I said in the slide, the price had gone up by about 4 lakhs compared to the launch price over a 3-year period. And we felt that if you're getting the benefit of this, we should firstly pass that benefit to customers, secondly use that as an opportunity to grow the size of the pie. And that gives us operating leverage. We have been able to bring our costs down through multiple initiatives. So that's the 700 specific question. Your question was, will we do that on other products? I think the philosophy is the same. So if we feel that we need to do it somewhere else, where we feel that there's an opportunity that we see for growth, we would do that. I don't think we plan to do that indiscreetly, and I don't think we plan to do that across a whole portfolio of products. But it's not like we will never do this again. In any segment, we will try to do the right trade-off between a sweet spot customer price, the right margin, and the ability to grow volume. So, it's our role to juggle these three variables. So that's on the first question. Are these margins close to peak? I'm guessing your question is there more upside? Our role is to create upsides all the time, and we will work hard to do that. When and how that plays out is something that we would amount to guidance, so we won't. But the direction is that, as we would want to grow our business fast, keep price points intact, manage costs well, so that, the end result of margin is something which people are happy about. Like, I think we all feel good about having got to 9.5% margin, but we wouldn't feel good if you got to 9.5% margin and didn't get growth. So it is about managing both of these together. Anish, you want to add?
Oh, I think that's perfect.
Yeah. I think your last question was on EV, and how do we see that? We continue to remain optimistic about our EV plans. As we've shared earlier, we believe the country needs a strong electrification drive. We believe we've created products which will excite the market, and we will be on track for launching our new electric vehicles in 2025. Thank you.
Yes.
Hi, this is Ryosuke Hanada from Nikkei. I have two questions. First is regarding the union budget. So last week, the new union budget was announced by the government. And first, what do you think of the impact of the new budget, especially regarding the auto business? And secondly, a few months ago, the Mahindra announced the 27,000 crore investment for the automobile business. And as of now, is there any minor change or update will likely happening in this 3 years plan?
So starting with the budget, we actually feel it's a very good budget because it's a development-focused budget, consistent with what we've seen in the last couple of years, and that would be a positive for the economy. It is also a budget that focuses on inclusive growth and positions India well on a path of significant growth over the next few years and potentially beyond that. From that standpoint, it's positive for the auto industry and across other industries as well. So there was nothing specific that I would look at and say, here's a key change, but that's the way budget should be. It should be focused on long-term development growth. On the second point, Rajesh, do you want to take that?
Yeah, I'll just add one comment to what Anish said on the first point. 65% of our pickups are from rural India, and of course, 100% of our tractors are from rural India. We see a very clear and much needed focus on strengthening both the agri economy through multiple productivity measures that have been announced in the budget, and a desire to overall improve prosperity levels in rural India through rural spending, infrastructure creation. And we believe this will help both our businesses, the tractor business, especially the pickup business, and some part of the auto SUV business as well. Some of our products are very rural focus. So we think it's a very positive budget with a very strong focus on rural and agriculture. I think your question was on 27,000 crores. Is there any change in the plan? No,
Yes.
there's no change in the plan.
Okay. Thank you so much, sir.
Yes, Amit.
Hi. So we spoke a little offline, but just for on the record. But the EV industry especially has been a little upset with that. The announcements didn't come through. Be from a Mahindra perspective in the three-wheeler business, if the subsidies do tend to taper off, then what kind of cost benefits from localization that we'll see that, or from better pricing that we can see that the business will be able to tide over when, if should the PM3 not really be as per expectations?
So at this stage, we don't expect anything different in FAME 3 than has been outlined. And I would give a lot of credit to the government for setting up FAME 2 and then EMPS, because this has enabled a very strong transition, and this is exactly how incentives should work, because the industry has gone from 0% to 20% electric for three-wheelers. And we expect it to be 100% electric by 2030, maybe even sooner. And we have told the government that after FAME 3, this is essential at this point to be able to continue that transition. But after FAME 3, there is a PLI that is existing already. The industry will not need any more incentives. And this is exactly how incentives should work, which is you create it for a specific time frame. You take it from a 0% to 100% transformation, and then incentives are not required. So far at least it's working as incentives should.
Anyone else? Nilesh, yes.
Hi. My question is, you spoke about the FAME scheme. Globally now there is a shift towards and rethinking towards EVs. Europe is seeing a decline in the sales of EVs. There are challenges. Numerous reports are coming and talking about like how there is a sentiment shifting towards hybrids. Recently, few Japanese OEMs have come together and spoken about biomethane engine, which could be a game changer because it takes residue as a fuel. So do you see this kind of a technological disruption also impacting Indian electric four-wheeler industry, especially given the fact that the electric four-wheeler industry globally has been based on incentives and heavy subsidies?
So let me start with the EV question, and then again we'll request Rajesh to get into more details on that. There are certain markets globally that, yes, there has been some noise because of the charging infrastructure or lack of charging infrastructure. At the same time, there are markets globally where they put in charging infrastructure, and Norway, for example, has greater than 90% EVs today. And you see the EV growth in China as well because of the number of chargers that are there in China is very significant. Now let's look at the key benefits of EV from an India standpoint. The primary benefits are, one, it has a direct impact on emissions. And that emission impact will have a major benefit for our cities that have a higher pollution level today. And second, it has a direct impact on fuel cost reducing, which is again a big part of the fuel bill that the country is concerned about, even from a geopolitical standpoint. So these are two things that EV does that none of the other products can today. And therefore, EV will be the game to play, and that's the reason why governments around the world have been incentivizing EVs. Now, India today is at 1.5% penetration of EVs. Markets are facing problems from a charging standpoint at about 20%. We've got a long way to go. The starting point is what we call as products that are desirable. A consumer sees a product and says, I love this product, I must have this. That is something that hasn't quite come into the India market as yet. And as that comes in, you start seeing a greater pull for EV, and that starts creating a demand. The lessons we have to learn from the world are to create a much better charging infrastructure at a much faster pace, so we don't face the same level of hiccups as some of the markets around the world have.
I think Anish covered everything by and large. Nilesh, I would just add that one of the challenges the Western world had, especially Europe, is most of the cars that were built on NMC technology, which the costs of which stayed very high compared to LFP. And a lot of what we are doing is, we are doing only LFP as we go into a new product. So the relative cost compared to NMC is a much better equation. And of course, I just want to reinforce what Anish said, that they have started seeing some saturation after 15, 20, 25% penetration. We haven't even got started. So, I don't think the situation is comparable at all.
And on other technologies, there will continue to be lots of technology advances, and some will work, some will not work. We've always felt that these are different powertrains. There are a number of other aspects in a vehicle that have to be done. And as different powertrains come, we will continue to look at them. And as some of them take off, we will move fast and get them as we need to.
Hi.
Yeah, Shahakar.
Yeah. So I just wanted to understand from your side, how do you see the bus and truck business of yours from the whole, holistically towards the profitability side? I mean, because since FY19, the business, has taken a slightly backseat. So if you can provide some color on it, that will be nice.
Yeah, sure. Thanks. And I know you've spent some time with us understanding the business, so let me try and add a little bit to what you already know a lot about. We did lose some market share in the COVID transition, and one of the main reasons for that was, Maharashtra had one of the worst COVID situations. Supply chain was totally disrupted. A lot of the, the incoming parts, especially on engines, were coming out of same sources. So we were struggling to prioritize between our product portfolio. We, at that stage, ended up deprioritizing availability of trucks and buses. So we did lose some share from around 5% in the segments in which we play, which is about 80% of the market, to about 2.5% over that period of time. We put in a lot of focus to get the business back on track. The market share in the 80% of the market that we play in is close to 3.9%, which has moved up from 2.5. So every quarter we are seeing growth come in. Our strategy to drive growth has been very calibrated. So we are kind of saying, let's take 30-40% of the geography, focus on it, get the dealers there to a certain level of critical mass, and then add on, rather than trying to spread ourselves too thin and try and do, a little bit everywhere. I think that seems to be paying off because, a lot of the improvement we're seeing coming out of the areas in which we are very focused. In those areas, there are dealers who crossed 8, 9, 10, 11, 12% kind of market shares as well. So in a way, at the moment, we're very focused on picking geographies. We have a good product portfolio, getting those in with customers, building word of mouth. So it's a category, as you know it well. You have to you have to prove your product and get word of mouth, and that's what gets you credibility and then more business. So it's not a, one shot, let's do something and you're going to get the result the next time. So we've, over the last 2 years, have made a reasonable comeback, and the industry has a very good profit pool. So, as we move up from here, from, 3% market share to 5, back to 5, and then hopefully onward to 7, 8, we should see a very substantial top line. Even at 3% the top line is 3,500 crores. So, just the multiplier effect of industry growth and moving market share up should get us to about 10,000 crores top line in the next 3 odd years. And the industry is a very good profit pool. So, once we are at that level, we'll also make a lot of money, but we don't lose money now.
Sumatra.
Good afternoon. I'm Sumantra Barua, representing ET Auto. First, congratulations on the good set of numbers. I'm curious to understand, Volkswagen is looking at a partner in India, local partner for sustainable growth. Is Mahindra interested to be that partner, considering that you already have a collaboration for EVs? One is that. And secondly, in terms of manufacturing, I want to understand what's the current utilization level. And there are also some concerns in among some people in the industry that there is another semiconductor crisis approaching a few quarters down the line, expected rather. So do you also share that same viewpoint? And if yes, how are you preparing for it?
So I'll take the first one. For us, we've had a very good relationship with Volkswagen. We've got a deal with them, as has been announced already, with regard to self-purchasing and some components of the MEB platform. And that is a good relationship. And while there are lots of rumors around, we continue to hear rumors on various different things. And I'd say that at any point in time with any of our businesses, if there is a solid reason to do a partnership that benefits us, then that's something we would look at. But that's where we are right now. On the second point, the team has done a lot of work on semiconductors and looking at backup options. In the past, we never really focused on anything beyond the supplier who was giving us the component. Now we're looking at their suppliers as well and saying, okay, what if that component doesn't come in? What are multiple options that can be created? And a lot of work has been done. So therefore, my sense is in a semiconductor crisis, again, we are very well prepared. Right? What our teams are also preparing for is crises that we don't understand where they're coming from, because that's a bigger problem in the world today. So how can we be agile and react quickly to different things? So that is what I'm more worried about than the next semiconductor crisis. Harish, anything?
Yeah, so I think Soma, we're well prepared on semiconductors. By exactly as Anish said, creating multiple sources. Multiple sources have already been validated. So we have different sources for every type of chip. If they are validated and available with the supplier, we have visibility to what those alternatives are and where they will come from. We had no visibility of this when this hit us in 2020. Like Anish said, we didn't, and most OEMs didn't know who was the tier 2 for chips. I mean, it was a commodity which no one was tracking. So we are significantly well prepared for it, and hopefully we'll overcome in a much better way any crisis that may come. That doesn't mean that you, in a deep global crisis, you won't lose any volume, but, we had kind of lost 40-50% volume the last time this happened. So we are much better prepared. You also had a question on capacity utilization. We're right now doing about in the region of 42,000 SUVs. Our capacity is 49, so we are at about 80% plus utilization of that capacity. But, the way we've thought about it is the cost of capacity creation is negligible in the overall investments that we do compared to the opportunity loss of not leveraging it. So in a way, any good OEM should have a capacity utilization of 80-85%, so you're prepared for upsides that may come your way or growth as you focus on specific products. So I think that's where we are at right now. And as we've shared, we remain optimistic about being able to do mid to high teens growth in our SUV portfolio for the full year F25.
Would you also throw some light on what is the production capacity you are earmarking for MEAL?
I think that was on the slide, Sumo. If I remember right, when we finish F25 the current year, we would have added about 100,000 capacity for Born Electric. That capacity sits in M&M, doesn't sit in MEAL, but it's for the electric SUVs which are under MEAL. And then we add another 100,000 odd as we get to the end of F26, but we can, kind of phase that out as we need to. So broadly, as we end this year, we'll be ready with about 100,000 capacity for Born Electric, but it's a part of the M&M capacity for electric SUVs.
Thank you.
Yes. Prerna.
Hi, this is Prerna from Autocar Professional. So we know that passenger vehicle demand is still under stress. At some dealership level, there's an inventory pile-up issue. So what is your outlook with that regard going forward for the next few months? And just to clarify, since you've announced some price cuts, do you not expect that to hurt your margins going forward? Just to clarify that. Thanks.
Yes, on the second point, I had that on the slide, Prerna. We don't expect it to significantly impact us financially because we've used a certain logic. I'll just recap that quickly. We expect volumes to grow. Volume growth will get us operating leverage. Our costs have come down. We are passing on some of that benefit to customers. And so on a holistic basis, we think this is going to have negligible financial impact if our volumes go as per the growth plans that we have, we seem to be reasonably confident of that. On dealer stocks, they're higher than our norm by 4 to 5 days. So I don't want to say that the stocks are absolutely on the norm that we want. I wouldn't use the word piling up. So the dealer inventory is a little higher because of April, May, seeing a significant slowdown across the board, and there are many reasons. One was the weather, the elections happening, so on and so forth. So, retails have started picking up from June, July for everybody in the industry, and stock would correct itself over next month or two to what are more normative levels. But we're not certainly in a situation where we see stocks piling up. Demand is also not a problem, you said? Yeah, I mean, we are seeing reasonable offtakes. As you saw, we had good bookings in June, and July bookings have been very healthy as well.
I'll take a few online questions. Alisha Sachdev from the Mint would like to know if you are taking any measures to diversify the powertrain mix in our SUV portfolio at present. Can you elaborate if there is any progress in the study of a hybrid strategy for M&M or any other alternative fuels which can help you reduce diesel dependence? And she also wants to know any other measure to meet stricter CO2 emission norms.
Hi, Alisha. So on the diversity of the powertrain, basically right now, as we've said, we have 3 primary powertrains, gasoline, diesel. We do have CNG on the pickup and some other products. And then we have the electric strategy coming up. So we at this point of time believe that that's the right path to go. and we get confidence that that's the right direction from a national priority as well. Anish, do you want to add on that?
I just say that if there is a very strong consumer demand for hybrids for other powertrains, we can get that at a reasonable time frame as well. So from that standpoint, we feel pretty confident in terms of where we are positioned right now. And in terms of the electric pickup, again, based on the previous question as well, we feel pretty good that with the product set that's coming out, we will be very, very favorably positioned.
Yeah. Astha Oriel from Business Today has 3 questions. The first is, what is the average waiting period across all models? In fact, Nandini Sengupta also has the same question. She wanted specifically to know about the production, the waiting period for Thar and Scorpio N. And that's one. Second is, what's the current inventory, given the dealers have already raised concerns regarding high inventory levels? And the third is, what's the outlook of tractor and LCV segment going forward?
So waiting periods, Nandini and Asta, I think both of you have the same question. We actually hope we don't have to have this conversation, and which is why we said we want to do away with that slide, because it's actually not a customer-driven slide. We want the waiting periods to be as less as possible, and that's the reason we've taken our capacity up from 18,000 a month to 49,000 a month, so customers don't have to wait. The Thar two-wheel drive or the rear-wheel drive and the Scorpio N do have some waiting period. 3XO has a little bit of waiting period as well. They're within a reasonable level of a few weeks now, and not, what we were very uncomfortable with. So, on an average, these products would probably have a waiting period of about 8 to 10 weeks, depending on the version and the model. Inventory levels, I think answered that question already. So, and I'm not planning to answer it again. And then what is the outlook on tractors?
Tractors and LCV.
Yeah, so the outlook on tractors is will be maintain it at 5% for the full year. But there are several positive enablers which I covered in the presentation. Let's see how that plays out, and we may have a better visibility and view as we come closer to the festival season. On LCVs, it's been a difficult year for the segment. Last year was negative, Q1 is negative. But typically we see pickups lag growth in tractors. So you start seeing rural spending first, translating into tractors and then LCVs. Hopefully we should start seeing growth in the second half on the LCVs category.
I believe Lala's here. He has a question. Yeah, at the back.
This is Lala Business from the Hindu. Need to have an update on the Baptista, whether it's there in India or not, the volume that has been done, and is there any business that you're planning to exit which is not doing 18% ROI? Thank you.
No, we're not planning to launch it, but it's in India. One of the reasons being it's developed in left-hand drive and not in right-hand drive. Other reason is probably you don't have enough ground clearance to successfully run on Indian roads. So combination of these two reasons, no plan to introduce, but it's in India. On the ROE question you want to, Anish?
Yeah, ROE question, we've completed all the exits that we had to. The businesses that we have actually are on a good track right now. Trucks and buses, a question was there earlier, it's now profitable and actually looking very positive as well. That was one of the businesses that was on the cusp in our category ABC definition at one point. And we took a call that we like the business, we want to stay with it. And it's actually one that I think will be a strong mainstay for us as we go forward in the future. So at this point, the good part is that our businesses all are running on firing on all cylinders. That's a good place to be. For us, the operating performance is the most important one that we look at. Are we operating them well? The answer to that is yes. And we continue to monitor them. So if there is something that falters, and and we feel that it doesn't have a future, then we will look at it at that point. But thankfully, right now, we are on a good track.
Tushar from
Just
NTT.
about the 18% ROE
Good afternoon,
being
gentlemen.
average.
Tushar from NHG Profit. First question is on reduce the prices of the AX7 last month, while you launched a new model as well as Select. So the reason that was given at that point of time was price rationalization. So do you see the scope for variant rationalization as well, reducing the number of options for buyers and actually sprucing them up in terms of features so that at least that price rationalization front is also maintained? Do you see the scope? To that end, what is the average selling price of an SUV for you at this point of time, given that you have increased your revenue market share about 130 basis points? That's my first question. Second question is on the demand for 3XO and the variants in that space, and what are your expectations from the Thar 5-door? Number 3 question is on the cyclicality in the CV or the tractor business. Again, you're seeing the highest ever quarterly volumes for the June quarter. Do you think the cyclicality is now over? Are we looking at a growth period from the next quarter? Thank you.
Okay, I'll just make sure I've got all your questions right. The first one was on the varianting strategy for 700 and average SUV selling price. The second one was on what's happening with 3XO demand, I think. Was that?
The demand expectations from the 5-door.
And that was the third one, which is the
second one. Both.
Yeah.
Yeah.
Okay.
And the one with the on
CV cyclicity.
Yeah.
So on the 700, we have done some variant addition, like AX5 Select was exactly what you're saying, which is, taking a current variant, strengthening it with new feature offerings, creating a sweet spot price so that you create demand around that. For example, we added panoramic sunroof and a few other things and created AX5 Select. So that was exactly what you're saying, which is re-varianting in a way. And that's something we keep doing, and we would continue to do that. On 700, we are typically not good at dropping models. So if your question is, will that help us rationalize the number of variants? Actually, we should do more of that, but we end up, complicating our lineup every time, which is good for customer, but difficult for supply chain. But we now have a reasonable amount of commonality across variants on the platform. So the supply chain complexity comes down a lot. And, we believe that if we are able to give customer a high variety while keeping our supply chain rationalized because there's high commonality across variants, then it's actually a good thing to do. And we have been able to do a lot of that on 700. Rajiv, you have an exact number of average selling price? Or should I kind of guess? My guess is it will be about 18, whole portfolio. Oh, no, you're asking for the whole SUV portfolio? Yeah. Yeah, so but now 3XO is coming to mix. Maybe 15 lakhs customer price, I think would be about with the 3XO coming in, which has a large volume at a lower price point. We are very excited with the Thar Rocks, and initial feedback has been overwhelming. I'm sure you love to hear more about that across the 14th and 15th of this month. CV cyclicity, I guess that's a part of the CV and tractor industries. You do see the ups and downs. At least in the LCV segment, we do think we will see some kind of an upturn, and we are already seeing that in some segments in the heavy and truck business. That industry hasn't really shown a lot of growth for the last few years. So there is a lot of upside as government spending in infrastructure goes up.
We'll take the last two questions. Akbar, Amit, you have asked. We can look at that later. Take yours later. Yeah, thank you.
Thank you for this. My question is to Mr. Jejurikar. First of all, on your off-road, on your rugged SUV portfolio, you guys have around 40,000 plus booking for the Thar and around 55,000 for the Scorpio lineup. Now with the new off-roader coming in, what kind of cannibalization are you seeing between both? Because there will be some sort of an overlap in pricing with powertrains. And also, are you looking at waiting periods coming down for the other two, the waiting period coming down for the other two models? And also, what kind of capacity are you looking to add for the 5-door?
Okay. There will be some cannibalization certainly between Thar Rocks and the current 3-door. That's factored into the way we've created capacity. If there's a good mathematical model by which we can calculate what that cannibalization is, we would love to hear. We are factoring in some